Most people will never build real wealth from investing. Not because the market is unfair, not because they started too late, not because they did not have enough capital, because they never had a framework. Welcome to the Profit by Friday podcast, where we replace guessing with process, emotion with discipline, and noise with one clear idea every single week. Let us get into it. You did everything right. You watched the earnings come out. Revenue up, profit up, earnings per share beat the estimate. The stock dropped 8% the next day. You sat there staring at the screen wondering what just happened. This is one of the most common and most frustrating experiences in investing, and almost nobody explains it correctly. Most videos will tell you the stock dropped because it missed expectations. That is true, but it is the surface answer. The deeper answer is what actually makes you a better investor. Today, we go deep on the earnings pillar of the clear framework. And by the end of this episode, you are going to understand why the headline earnings number is one of the least useful numbers in the entire report, and what to look at instead. Here's the first thing you need to understand. Earnings are not cash. Earnings are an accounting construct. A company can report growing earnings every single quarter and simultaneously be running out of cash. These two things are not contradictions. They happen all the time. And investors who only look at the earnings number miss it every single time. Here's a simple example of how this works. A company sells software subscriptions. They sign a 3-year contract worth $3 million. Under accounting rules, they recognize that revenue over 3 years, even though the cash came in on day one. The earnings look moderate. The cash position is strong. Now flip it. A company sells physical goods. They ship the product in December. The customer pays in February. The revenue and earnings are recognized in December when the goods shipped, but the cash does not arrive until February. The earnings look strong. The cash position is weak. Same business performance. Completely different picture depending on whether you look at earnings or cash. This is why free cash flow is the number that matters most. Not accounting profit. Free cash flow is the actual cash left after the business has paid every operating expense and made every capital investment required to keep the business running and growing. Free cash flow does not lie. You cannot manufacture it. You cannot smooth it with accounting adjustments. It either exists or it does not. When we score a stock on earnings in the clear framework, we are not just asking whether earnings grew. We are asking 4 specific questions. Question 1. Is revenue actually growing or is the company manufacturing profit through cost-cutting? This distinction is critical. A company can show growing earnings 2 ways. It can grow revenue, or it can cut costs. Revenue growth has no ceiling. Cost-cutting has a floor. You can only cut so far before you cut into muscle. Before you eliminate the people and investments that drive future growth. A business that is growing earnings by cutting costs is a business that is borrowing from its future to look good today. When you see earnings growing but revenue flat or declining, that is a red flag that demands deeper investigation before any capital is committed. Question 2. Is the gross margin expanding or contracting? Gross margin is the percentage of revenue left after the direct costs of delivering the product or service. It is one of the clearest signals of business quality available in any earnings report. Expanding gross margins mean the business is getting more powerful over time. It is either raising prices, becoming more efficient, or both. Every point of gross margin expansion flows almost entirely to the bottom line. It compounds. Contracting gross margins mean competition is intensifying. Input costs are rising faster than the business can pass them on, or the product is commoditizing. Any of these is a structural problem that takes years to reverse. A business with consistently contracting gross margins is a business losing its competitive position slowly and quietly, while the headline earnings number distracts you from what is actually happening underneath. Question 3. Is the business generating free cash flow? We covered this already, but it is worth stating as a specific check, because it is the one most investors skip entirely. Take the operating cash flow from the cash flow statement. Subtract capital expenditures. That is free cash flow. If that number is growing alongside earnings, the earnings are real. If that number is flat or declining while earnings are growing, something in the accounting is doing work that the business itself is not doing. A business that consistently converts a high percentage of its earnings into free cash flow is a business with genuine economic strength. One that consistently fails to convert earnings into cash is a business with a problem it may not be disclosing clearly. Question 4. What does the forward picture look like, based on what the business has already built? This is where most earnings analysis stops being backward-looking and starts being actually useful. Management guidance, contract backlog, customer retention rates, pricing power signals in the transcript. These are the indicators that tell you whether the next 2 to 3 years look better or worse than the last 2 to 3 years. When a stock drops after a good earnings report, it almost always means the forward picture disappointed, even while the backward picture looks strong. The market is not rewarding what already happened. It is pricing what it expects to happen next. Understanding this one fact changes how you read every earnings report from this point forward. The stock dropped not because the earnings were bad. The stock dropped because the guidance was weak, the margin trend reversed, or the free cash flow conversion disappointed. The headline number was fine. The quality underneath was not. That is the earnings pillar of the clear framework. 4 questions. Applied before any capital moves. Amateurs read the headline. Investors read the quality underneath it. The headline tells you what happened, but quality tells you what is happening. Go to ProfitByFriday.com for more. I will see you in episode 5.